The stock market is reeling. President Trump has just launched a sweeping new tariff policy, triggering the biggest single-day drop in the Dow since 2020. Some investors are panicking, but others are asking a smarter question. Could this be an opportunity in disguise? In this video, we'll break down exactly what these new tariffs are, what sectors they're hitting the hardest, and how you can adjust your investment strategy to ride out the storm, or even profit from it. Let's get into it. This is The Alternative Investor. Welcome back to The Alternative Investor, where we bring you real-world investing strategies, deep-dive market insights, and the kind of financial coverage that cuts through the mainstream noise. Make sure to like and subscribe if you're serious about mastering the market during moments of volatility, and if you're ready to start investing, or want to take advantage of market corrections, use the Robinhood link in the description to claim a free stock today. Now let's get into Trump's bold new tariff plan and what it means for your money. On April 2, 2025, President Trump introduced a set of aggressive new tariffs as part of what he's calling the Liberation Day Initiative, a protectionist economic strategy aimed at revitalizing U.S. manufacturing and correcting trade imbalances. A universal 10% tariff has been slapped on all imported goods, regardless of origin. This means everything from electronics to clothing will be more expensive at the port, and likely on the shelves. China faces up to 54% tariffs targeting consumer electronics, auto parts, and critical minerals. The EU faces 20% tariffs hitting luxury goods, machinery, and cars. Japan is hit with 24% tariffs, particularly on semiconductors and electronics. This isn't just political posturing. This is global economic warfare, and it's being waged on America's biggest trade partners. While Trump argues it's about economic independence, the ripple effects on businesses and investors could be massive. Markets wasted no time reacting to the news, and the results were dramatic. The Dow Jones Industrial Average dropped 1,680 points or 4% in one day, its worst single-day loss in 5 years. The S&P 500 fell 4.8%, erasing nearly all of its year-to-date gains. The Nasdaq sank 5.9%, with tech stocks leading the sell-off due to their heavy exposure to global supply chains. Safe havens surged, treasury bonds, gold, and even Bitcoin saw inflows. Volatility skyrocketed, with the VX jumping over 35% in a matter of hours, signaling heightened investor fear. Sectors hit hardest: tech, industrials, consumer discretionary, and global exporters. Investors are pricing in higher production costs, disrupted supply chains, and potential retaliation from foreign governments. This is more than just a correction, it's a recalibration of expectations for earnings, margins, and growth. This is not just a US problem, it's a global disruption. China has already threatened reciprocal tariffs on U.S. agriculture and tech hardware. The European Union is reportedly preparing a countermeasure package targeting American cars, tech firms, and aviation products. Japan issued a formal protest through diplomatic channels, with rumors of a WTO challenge on the horizon. European markets dropped 3 to 5% across the board. Asian markets, especially China's CSI 300, fell over 6% overnight. The dollar briefly surged before pulling back on fears of recessionary feedback loops. Goldman Sachs revised their U.S. GDP growth forecast down from 2.2% to 1.6% for the year. Multiple analysts are warning that a full-blown trade war could tip the U.S. into a recession by mid-2026 if left unchecked. Bottom line, these aren't just tariffs, they're economic shockwaves, and they're being felt around the world. In moments like this, fear leads the headlines, but smart investors look for positioning. Sectors like utilities, healthcare, and consumer staples tend to perform well when the economy slows. These companies offer steady cash flow and dividends, making them reliable during downturns. Companies with minimal exposure to global supply chains may see less impact. Think regional banks, domestic retailers, or home builders that source locally. Big tech may take a hit due to its global footprint, but some oversold names could present long-term buying opportunities. Watch for valuation resets in companies like AMD, Google, or Meta. Gold, commodities, and even Bitcoin could serve as a hedge against geopolitical risk and inflation. Consider increasing allocations slightly to these asset classes if appropriate for your strategy. A market shock doesn't mean stop investing, it means invest smarter. So now I want to hear from you. Do you think Trump's new tariffs are a strategic move or an economic time bomb? How are you adjusting your investments in response? Drop your thoughts in the comments below. I respond to as many as I can. Don't forget to like and subscribe for more no-fluff market updates, financial deep dives, and strategies to protect your wealth in uncertain times. And if you're just getting started or want to grab a great deal, use the Robinhood link in the description below to claim your free stock today. This is The Alternative Investor, and we'll see you in the next video.